and gentlemen, good morning and welcome to the VRL Logistics Q4 FY2025 Earnings Conference Call hosted by Motilal Oswal Financial Services Ltd. As a reminder, all participant lines will remain in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star, then 0 on your touch-tone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Alok Devra from Motilal Oswal Financial Services for opening remarks. Please go ahead.
Thank you. Good morning, everyone, and welcome to the Q4 FY2025 Earnings Conference Call of VRL Logistics. So today we have with us Mr. Sunil Nalavadi, the CFO of the company. I will now hand over the call to Mr. Nalavadi to provide some opening remarks and discuss on the performance, and then we can pick up the Q&A session. Thank you, and over to you, sir.
Yeah, thank you, Mr. Alok. Good morning to all participants. I am Sunil Nalavadi here, CFO of VRL Logistics Ltd. I welcome all of you once again for the earnings conference call for the Q4 of financial year 25. This is again a strong quarter marked by revenue growth, substantial improvement in profit margins, and robust cash flow. On a year-on-year basis, the revenue of the quarter is increased from 772 crores to 812 crores, with a growth of around 5%. The growth in revenue is mainly on account of increase in realization of freight per ton, increased by around 18% from 6,724 per ton to rupees 7,944 per ton. In addition to the freight hikes implemented in the earlier quarter of this year, in the current quarter, we further analyzed most of the business transactions or contracts with their contribution to the margins and potential addition to the overall tonnage of the company. In this process, we identified certain low-margin business and discontinued such businesses which impacted on the tonnage. In view of the same, we reached a higher ever EBITDA and EBITDA margins in our business in the current quarter. We reached a volume of around 10,06,000 metric tons in the current quarter, and the negative growth in tonnage is due to discontinuation of a low-margin business in the current quarter. On a year-on-year basis, we added around 84 branches, and these branches contributed around 1% to the total tonnage. We also closed around 40 branches, considering the potential of these branches business can be served from the adjoining branches. We continued our initiative to increase the number of branches in the current quarter and added around 5 new branches. Apart from this, the management of the company undertaken many steps to control the key operational costs, such as increasing quantity of bulk purchase of fuel directly from the refineries and key route mapping to minimize the number of loading and unloadings, which resulted into optimum utilization of our own vehicles and drastic reduction on dependency of the hired vehicles. The EBITDA is increased by around 74% from 109 crores to 189 crores, and percentage to revenue is increased from 14% to 23%. Further, the margin improvement is also due to good control on fuel expenses, which is major cost of operation in our business. And we further increased the bulk purchase quantity in the current quarter from 31% to 42% of the total quantity consumed. The fuel procurement cost per liter is reduced from 87 rupees to 84 rupees. On overall basis, the fuel cost as a percentage to the revenue has been reduced from 29% to around 26%. The improvement in operational efficiencies in the current quarter also leads to improvement in EBITDA margins. We saw major efficiency in effective utilization of our own vehicles. This has supported us to have a control on the dependency on the hired vehicles, due to which the lorry charges has been reduced from 8% to 4% to the revenue. The rest of the expenses either in line with the revenue or reduced as a percentage to the revenue due to increase in freight realizations. The improvement in EBITDA lead to increase in EBIT and the net profit margins in the current quarter. The net profit of the company is increased from 21 crores to 74 crores in the quarter, and percentage to revenue is increased from 3 to 9%. On a sequential basis, the revenue is decreased from 831 crores to 811 crores. The growth in revenue is impacted due to decrease in volume by 9%. From 11,04,000 tons to 10,05,000 metric tons in a quarter. The decrease in volume is on account of discontinuation of a low margin businesses and due to which the realization is improved by almost 7% from 7,390 rupees per ton to 7,944 rupees per ton. Due to improvement in realization, the EBITDA margin is improved from 21% to 23%, from 172 crores to 189 crores. And the improvement in EBITDA margin is also due to increase in bulk purchase of fuel quantity from 39% to 41%. However, the purchase cost per liter is increased from 83 rupees to 84.5 rupees due to increase in rates by some of the state governments. The overall fuel cost as a percentage to the revenue is reduced from 26% to again 25%. And due to further control on the hired vehicles in the current quarter also supported the improvement in EBITDA margins by 1%, and the remaining costs were more or less in line with the revenue. On full year basis, the revenue is increased from 2,909 crores to 3,186 crores, and increase is mainly due to improvement in the realizations. The realizations are improved due to increase in freight rates from the second quarter of the last year, and a thorough analysis of business contracts in terms of margins and discontinued some of the low margin business in the quarter 4. The realization per ton is increased by 10% from 6,682 rupees to 7,315 rupees, and the volumes are maintained at around 42,72,000 metric tons despite the substantial increase in the realizations. The EBITDA of the company is substantially increased in financial year 25 from 414 crores to 598 crores, and the EBITDA margins improved from 14% to 19%. The increase in EBITDA is due to increase in realizations, decrease in fuel costs, lower hire charges, and control on the remaining expenses, which are more or less in line with the revenue. Due to increase in EBITDA margins, the net profit of the company is increased from 89 crores to 183 crores. With the improvement in profitability, our cash generated from the operational activities increased from 409 crores to 587 crores. And with having good control on working capital, our post-tax net cash generated from operational activities has been increased from 423 crores to 558 crores. These cash flows numbers are subject to the Ind AS accounting entries. The strong cash flows mainly through the internal accruals of the company, which led to robust expansion in the company, robust expansion plans of the company. And the current year's strong cash flows enabled us to make major capital expenditure of around 440 crores in a year, including investment in purchase of some of the facilities at Bangalore, Mysuru and Mangaluru, along with our routine capital expenditure on the vehicles. The investment in Bangalore transshipment hub is having its own business advantages with better financial metrics, which have been already shared during our quarter 3 results. The strong cash flows enable the company in maintaining optimum debt equity ratio of 0.4 times to the equity, with a total net debt as of 31st March of around 396 crores. We wish to inform you that there is a considerable improvement in the return metrics as well. The return on capital employed is increased from 10% to 14%, including the lease liability as a capital employed, and the return on equity is increased from 9% to 18%. Considering the improvement in margin and the robust cash flows of the company, the Board of Directors recommended rupees 10 per share as a final dividend for the financial year 25, which is subject to approval from the shareholders in the ensuing board meeting. With this final dividend, the company declared highest ever dividend of rupees 15 per share, and reflecting the company's strong financial performance and commitment to delivering value to the shareholders. Further, our business is a B2B local focus on a less than truckload business with a wide range of customer base of around 9 lakh customers, covering with wide range of sectors. Our key strength is having the different mode of collections from the customers, and 85% of our less than truckload business is on either paid or to pay basis, collecting the freight on spot from the customers immediately after the booking or after the completion of the service. Our receivable days from the customers is hardly around 11 to 12 days, and which is lowest in the industry. The company experienced a strong quarter with a robust increase in freight realization and notable improvements in the profit margins. supported by operational efficiencies, cash flow from operations remain robust, and positioning the company well for future growth and investments. With these achievements and positive outlook, we are confident that in maintaining the momentum moving forward. We also would like to emphasize that the reduction in volume is temporary scenario for a quarter or two, and the growth of the tonnage the tonnage growth will be back as usual normal from quarter three. That's what we are expecting. Considering the wide range of customers and sectors where we are operating, we are expecting that we will put all our efforts to perform better in the industry. With this, I would conclude my initial remarks. Now I will request all the participants to question and answer session.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use their handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Mukesh Saraf from Avendus Spark. Please go ahead.
Yes, sir. Good morning, and thank you for the opportunity. First of all, congratulations on great margin performance. So just on the lines of what you were mentioning with respect to discontinuing some of the low-yielding customers, could you kind of, first of all, help us understand if this activity is done from your side, or is there more such cleanup or discontinuation that we can continue to see going forward?
No, most of the activities have been already done. Actually, we started this exercise at the beginning of the March itself, since most of the agreements are due for the renewals. And even apart from this contractual customer, even some of the commodities also we have given some special concessions. So considering their contributions and considering the margins in those businesses, we have taken a step to cut down those facilities and again pushing for the growth in volumes.
Right. So just trying to understand that now that you're done with this cleanup, could you kind of help us understand what steps are we taking to get back some of the volume growth back in the system? Because the way I'm seeing, we've added 84 branches, but these branches have so far yielded just 1% growth in the tonnage. So, what steps can we take to get back, high single digit volume growth?
Yeah, basically we want to concentrate more on a healthy growth in the volumes. That's our primary objective as of today. And to increase the tonnage, definitely again we are putting more concentration on the increasing branches also. We are planning to add again 80 to 100 branches in the next financial year as well. And the branches which have been already opened in last year and prior to that, again we will put emphasis to increase tonnage from those geographies.
But yeah, finally you might be dependent on the general economic activity. And I think in the last few quarters you have mentioned that that hasn't been great. So if the activity doesn't improve on the ground, is there anything that we could do, say any new segments, any new geographies, any new services that we might want to kind of provide? From our side, what can we do to revive some of this growth?
Yeah, obviously on the geography front, as you are aware, actually we are most of the cases, new branches are opening in the untapped market. There actually we are expecting some good contribution from the volumes. And even in the current year, if we see wherever the eastern sector has been performed very well. So again, that concentration of the untapped market is going to be continued. But as you said, the overall economic conditions again, it is not up to the mark as of now. So considering those developments, so our tonnage growth will be dependent on the future days.
Right. So just lastly, if the tonnage growth remains weak and if competition kind of, obviously you're competing with unorganized operators, so if competition keeps their pricing low and our tonnage remains weak, will we kind of go back to some kind of pricing cuts to get back some volumes? Or are we okay with, again, another year of, say, flat or weak tonnage, while we'll continue to maintain this kind of pricing and will not go back into those low margin businesses again?
Considering all the aspects, actually, we did this rationalization in the freight rates. So definitely we will maintain, these rates going forward. And so this rationalization has been done keeping the competitiveness in the particular sectors or particular routes. So keeping in mind all the aspects, actually we did this exercise, and we will continue these relations.
All right. Understood. Great, sir. Thank you so much and all the best.
Yeah, thanks.
Thank you. The next question comes from the line of Pranay Roop Chatterjee from Burman Capital Management. Please go ahead.
Thanks. Good morning, everyone. Am I audible?
Yeah, please tell me.
The first question is on the wider demand. You were touching upon it in the previous answer. Keeping aside the impact of, voluntary client attrition, if I may call it that, keeping aside that, in your existing clients, let's say, who are with you even 1 year back, 2 years back, in those clients, are you seeing a general sentiment of demand coming back, volumes increasing? Is there even early signs of something like that happening, where, we can confidently say most of the sector is going to grow, upcoming year? Are we there yet, or, we still have to wait and watch?
The contribution from the existing customers is very nominal growth. It is in the range of around hardly 2 to 3%. But in the current scenario, what happens, since we try to maintain the relation and we to stick on to our pricing terms, so intentionally, actually, we close some of the low margin businesses, discontinued. And among these customers, again, they are approaching with our pricing terms and all. So going forward, we may not get the equivalent volumes, but at least we will get some volumes from such customers.
So my question was more on the wider market sentiment, with the context of, consumption categories being sort of muted for the last year and a half. So any sensible reverse looking beyond your own business?
Yeah, that growth is a very low single digit number. It's hardly in the range of around 2 to 3%.
Got it. And my last question is on pricing. So obviously, you have already commented that you will try to maintain the current prices. My question is, incrementally, FY26, 27 and beyond, basis your latest contract structures, how can you increase pricing further? I'm not saying you will, but what are the occasions? Like, is it 100% of all your contracts across clients linked to input prices like fuel, or you can take voluntary price hikes as well, probably like you did in Jan last year. So how should we think of price hikes and when it might happen in future?
Yeah, see, always our price increase is depending on the margins. If you see the rate increase, what we did in a quarter, end of quarter one or beginning of the quarter two in FY25, it was completely based on our margin structure. The margins have been dipped in quarter one only because of increase in the cost. So apart from the fuel cost, there are many expenses, say like employee cost and even the toll charges across the country. And many, the governments have been increased, especially in Karnataka and some of the states, they increase the permit fees on the vehicle. Vehicle tax rates have been increased. So considering these aspects, in the industry itself, actually, we are the first movers on the rate hikes. Even on the future dates, depending on our cost structure, we will take a call on the increase in rates.
Got it. Thanks a lot, sir. I'll get back to you.
Yeah, thank you.
Thank you. The next question comes from the line of Achal Lohade from Nuvama Institutional Equities. Please go ahead.
Yeah, good morning, sir. Thank you for the opportunity. Sir, first thing, in terms of the, volumes, what you mentioned is that you have let go the low margin segment. So was it for the entire quarter? You said we discontinued only from early March. So if you could give us a sense as to what was the contribution of this particular segment from a full year perspective in the past?
No, basically, we started this exercise in mid-February, and we analyzed all the contracts. And subsequently, we informed to the customers that considering the existing price versus what the realization and how much they are contributing to the overall volumes, we informed to the customers and we informed our new rate structures also. So whoever actually not accepted, we discontinued such business from the March.
Okay. So that means their contribution was there in January and February?
Yeah, the moment it started in February, actually they even shifted to some of the other operators.
Okay. So, which means it started from February itself, and March it got accentuated, and by March end you have fully done with that segment. Is that understanding right?
Yes, yes.
Okay. Now, if I were to ask you in terms of like-to-like growth, if you remove that customer segment or that particular segment from the base quarter as well, and for the entire quarter in March, what a growth would look like? Would that be flattish? Would that be a growth, or would that still be a decline?
No, without this exercise, we were expecting a decline of around 2 to 3% in tonnage.
Okay. So, is it fair to say that, the core business, the core segment, still seeing a decline? Is that understanding right?
Marginally in the range of around 2 to 3%.
Okay. And when you say we are looking for growth, how do we look at any particular segment, geography? Because you did mention about the branch addition, but we have seen the branch addition in the past hasn't really contributed a lot. So how do we see that, what will drive the growth?
So basically, overall, the economic sentiments are weak in the country. And if you take the realistic volume growth, even from the existing customers, is not up to the mark. So with this, actually, we are putting, all our efforts to, gather or acquire more and more customers. And especially, we, opened more of our branches in untapped market.
Okay. So, that brings me to the next question.
New branches, what we opened, these are all the contribution is small branches. See, initially we cannot expect good number of volume from these branches, but over a period of say 2 to 3 years, definitely we can develop good base of volumes from these branches.
Okay. And if I were to ask you, sir, what the branches what you opened say 3 years back, what is their contribution now? Is that 15, 20%, 25%, or is still 5 to 10%?
Yeah, 3 years back, and accumulatively, if you take, the new branches contribution is at least around 8 to 10% of the total volume.
Okay. Understood.
See, just around 3 years back, we are having around 940 branches. Now we reached almost around 1,251 branch. So the additional branches contribution is at least around 8 to 10% to the total volume as of today.
Understood. Sir, in terms of the, when you said the realization growth is not up to the mark from existing customer, what do you mean? You've taken if I remember right, 6 to 8% price hike, right? So, if you could elaborate a little bit on this particular, statement. Yeah.
See, basically what we did, we increased the rate by almost around 8 to 10% in the beginning of the quarter 2 in the FY2025. And during that exercise, actually, for the non-contractual customers, we increased our card rates. And considering some of the commodities also, we were given a concession, those concessions have been continued. And for contractual customers, what we did, actually, we increased the rate as and when those quotations or agreements are due for renewal. Since most of the agreements due for renewal in the month of March, and before renewal also what we did, we decided in the month of February that we analyze each and every business transactions. Either it may be the commodity transactions or some of the contractual customers, where exactly the relation is there. and we did some modification. Just to give you example, even in the cloth commodities also, see, we are not having any agreement with such customers. But earlier we used to give some free storage facility to them for at least around 30 days, 60 days, 90 days in some of the sectors. But considering the increase in the rent, considering the cost of that particular space, we reduced those number of days. Even such decisions have been impacted to some extent on the volumes. And now, and on a contractual customers, on the rate front, actually, we clearly said that these are the well-studied structure of rates what we defined, and these are all substantiated with the customer that why we putting the new rates, considering cost of operation, considering that particular route, storage facility, so many factors. So with that, even if such kind of explanation, some of the customers are not accepting, we said voluntarily discontinue such quantities.
And by and large, all these customer negotiation is done.
If you can.
Sorry.
Just a follow up, and I'll follow up. I'll fall back in the queue. Sir, by and large, all the customer negotiations are done, or it's still going on? Like 80-90% is done? Or?
Most of the negotiations and rate structure exercise, rationalization of the rates, that exercise has been already done, completed.
Done. Sure, sir. Thank you. I'll fall back in the queue for follow-up. Thank you.
Thank you. The next question comes from the line of Rahul Agarwal from Bandhan AMC. Please go ahead. Rahul, if you can please unmute your line and ask your question.
Hello.
Yes, Mr. Yes, yes.
Sunilji, the customers that we have discontinued, इसमें से how many would be the ones we would have acquired maybe last 1-2 years, and how many would be like our old customers, wherein we know there will be no turnaround?
No, most of these customers are old customers because whatever the new agreements we entered after the rate hike, actually we entered most of the agreements with increased rates only. So some of the customers are old customers with us.
And broadly, it's dominating which sector?
Not specifically sector. These are all mixed with all the sectors. And as I said, even the changing up of policy in some of the textile materials also impacted. It is contribution in all the sectors, not precisely particular sector, but most of the sectors are related to like hardware and electronic items, such commodities, even FMCG goods.
Okay. The second question from my side is for FY26, then you mentioned that X of this also you would have grown at volumes at -2 or -3%. So for this year, should we consider that maybe 2-3% volume degrowth, 6-7% realization growth, and a margin at the current levels? Is that a good outcome that we should work with?
Yeah, on a full year basis, yes. See, initial first 2 quarters, we are having a more visibility as of today. And we can give more clarity, after the quarter 2.
But broadly, this type of margins, which is like 20 plus, is that something which we have historically not seen to sustain, at least it sustains for a quarter or 2, but for the longer term, it doesn't sustain. So how do you view that? Is it that we have now sustainably reached 20% plus kind of margins, or you think there could be volatility in that also?
No, at least around 19-20%, that's what we are expecting to maintain, but more clarity will be given after the quarter 2. But initially, the quarter 1 and quarter 2, there will be dip in the volumes, but there will be more or less maintain the margins.
Okay, sure. Thanks a lot and all the best to you, sir.
Yeah, thank you.
Thank you. The next question comes from the line of Harish Shah from Rira Holdings. Please go ahead.
Yeah, hi. Good morning, sir. So my question is more from competition point of view. If you look at one of the listed peers who are also into partial truckload business, now they witnessed almost 19% volume growth in this quarter for this particular segment. And then when I look at their yield per kg, it comes to almost around 11 rupees, whereas we are at somewhere around 8 rupees. So just wanted to understand, while we are seeing 11% volume decline, the other listed player is seeing volume growth of almost 19%, and they are also doing better realization per tonnage. Just trying to understand this difference between our approach.
No, the realization, it depends on route also. Since we are having a lot of this intra-state movements as well, where the realization is less. In the sense, margins will remain same, but since the distance is less, the overall realization will look lesser than those operators. But most of their route structure is always the long haul operators. That's a key difference.
And so how would you explain the discrepancy between, because they are at 19% volume growth, we are at 11% decline, which would mean that they have taken a significant amount of market share, plus they have also reported very good profitability in this quarter. So just wanted to understand on that.
Yeah, this volume decline intentionally we have decided, and we analyzed some of the contacts, as I said, and we voluntarily decided to discontinue such business because of the low margins.
Okay. Understood. Okay. Thank you so much.
Yeah.
Thank you. The next question comes from the line of Raghav from Equatus Investment. Please go ahead.
Morning, sir. I just had one small question. What are the sectors that have contributed to growth in this quarter specifically?
Sorry?
What are the particular sectors which we have catered to, which have contributed to some growth in this quarter specifically?
No, there are no specific. One is the sector-wise growth as such. We are not depending on any particular sector, but since most of the sectors have been impacted on the tonnage because of discontinuation of some of the businesses.
Right, sir. Because I asked this question because normally we depend more upon FMCG kind of movement, but because that was muted, I wanted to gauge an understanding which sector has contributed to some growth in this quarter and which we can foresee for the next few quarters to grow.
No, basically, see, in that case, sector-wise contribution from each, if you take, it is not a considerable in our case. So cloth and textile is contributing major commodity, and again in that also we did a 8% negative growth. And next comes to agriculture and food products, again that has grown negative by around 6%. Like that, in metal and hardware, the growth is minus by almost around 13%, quarter on quarter.
Got it. Fair, sir. Thank you so much, sir.
Yeah, thanks.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star and 1. We take the next question from the line of Alok Devra from Motilal Oswal Financial Services Limited. Please go ahead.
Yes, sir. Just wanted to understand, after all these adjustments, we'll see volume growth under pressure for 1H at least of 26. So if we look at the full year, what kind of volumes we could end up with? What could be the realization like? Because the price hike benefit will go out after the first quarter, and some realization benefit will be there because of this restructuring which you have done on the individual accounts. And secondly, what would be the margins, sustainable margins ahead, because we did 23% this quarter. So FY26, if I want to sum it up into volume growth, realization and margins, then what it would look like?
Now, since this rationalization exercise has been done in the last quarter, so this negative growth, year-on negative growth will continue at least for the first 2 quarters, and we can see some improvement in tonnage from the quarter 3 onwards. Since quarter 4 tonnage has been already dipped, we may show some good growth in the quarter 4. On a full year basis, again, the more clarity will come after the quarter 1 or quarter 2. So depending on how the customer approach and all, actually we can give more clarity. And with the realization is concerned, we would like to maintain the existing realizations throughout the year.
So you mean 8% realization could be there for next year? for FY26?
Yeah, realization around the 6% it will come, 6 to 7%.
Sure. And what about margin, sir? This 23% margin which we did in fourth quarter, how that could shape up in next year, considering the volume trajectory and, realization, everything?
See, volumes, again, the quarter one, it will be maintained around at a good margin. But subsequently, what will happen, again, we have to consider some increment to the employee cost and other things. So based on that, the margins will be depending on these cost structures.
So any guidance you want to give? Could it be like 20% range for the margin for this year?
Yeah, that guidance can be more clarity will come, at least after quarter two.
Sure. Got it.
Yeah.
Yeah, I think that's from my side too. Thank you.
Thank you. The next question comes from the line of Krupa Shankar from Avendus Spark. Please go ahead.
Yeah, thank you for the opportunity. So one question from my side. Given that we are anticipating weakness in the tonnage, just wanted to get your sense around the capex number for the next year. Is there, while you did allude that scrappage of old vehicles will be quite limited going ahead, but we have seen close to about 300 plus vehicles getting scraped in FY25. Just wanted to get a sense on how do you see FY26 on your fleet procurement as well as, if any, capex towards network, like buying a hub or expanding your network, etc.
Yeah, considering our good cash flows, again, the investment in vehicles will be in the range of around 140-150 crores that will be there. And most of these capex will be for the replacement and with some minimal addition in the capacity. And apart from that, we considering again good cash flows and lower debt level, again, we are looking for investment in some of the properties, around 1 or 2 properties.
So far, what I can see is that you've taken Bangalore, Mysore, and Ahmedabad. Any specific areas where you can highlight? Is it increasing your capacities in the north and the east market because there is a growing demand over there, or is it in the existing markets where you're trying to expand based on demand?
Yes, there are some exercises are going in the Kolkata. Actually, we are doing some exercise, and in Pune also we are searching some property. In Salem, we are searching property. So, but nothing has been crystallized as of today. But definitely there will be 1 or 2 property addition will be there in the next year.
Got it. That's broadly from my side. Thank you.
Thank you. The next question comes from the line of Jainam Shah from Equirus Securities. Please go ahead.
Yeah. Hi, sir. Am I clearly audible?
Yes, sir. Please tell me.
Yeah. So just wanted to understand one part. As you are saying that our 85% of the customer are to-pay or paid customer, so rest 15% are our contractual customer, correct?
Yes.
So, sir, just wanted to understand on this part, as you are saying that we have started taking contract by contract rate revision, and that's where our realization has increased and tonnage has dropped. But if we see on a YOY basis, our tonnage has dropped around 10% plus. And if we see 2-3% is something that we are expecting, that balance 7% is because of this contractual customer maybe not coming, maybe not giving us business going forward. So out of 15%, 7% volume growth, does it mean that we have lost 40-50% business from our contractual customer? Because to-pay and paid customer, there will not be any contracts and we'll be getting it at branches only.
No, that understanding is totally wrong. As I said, it is not only contractual customers, even some of the business transactions, in the sense we have given certain concessions to certain commodities. Just I gave an example of textile. We were giving, a lot of these storage facilities, even 60 days, 90 days free storage. We cut down some of the storage facilities. And in some of the goods, actually, we were not collecting the additional charges like the loading and unloading charges we used to collect. Some of the stationary charges we used to collect. We are collecting from the normal transaction, but we have given concession to certain customers. So those concessions have been withdrawn, even for the non-contractual customers.
So, sir, assuming that this customer that we have taken back all these facilities would have been core customer for us, given that we have given them this kind of facilities only when we would have expected those overall industry or those customers to give us more and more volumes going forward. does it not going to impact our volumes drastically over next few quarters?
No, that exercise has been done and already the tonnage has been stabilized as of now. And these are, voluntarily, intentionally we decided to withdraw those facilities considering very low margin from those sectors.
Got it, sir. And the facilities that we would have withdrawn, let's say for warehousing, we would be giving for 3 months. Now we are giving for, let's say, 1 month or only. So those facilities has also been given back to the, let's say, vendor or anyone, or we are still holding those facilities and cost is still incurring on that?
No, those again, the discontinuation of some certain godowns and all, that exercise has been done. And moreover, these facilities or concessions are in line with other operators in the industry. That is another strength. So actually, nothing of these concessions are provided by the other operators in the industry. See, just to give some clarity on the textile, because most of the textile business actually, other than the organized players, they are depending on the unorganized service providers. And those operators actually are not giving, facility what we are giving. So considering these, factual things, we are hoping that again those customers will come back to us.
Got it, sir. And so just last one thing. As you have said earlier that we have taken 6% freight hike and rest of the realization increase is mainly because of the other cost which is being built up in our billing part. So fair to assume that that particular thing will continue going forward as well, as and when other cost increases will of course pass it on, but our normal freight rate will be the same going forward.
Yeah.
Okay, sir. Thank you so much. So that's it.
Thank you. The next question comes from the line of Anshul Agarwal from Emkay Global. Please go ahead.
Hi, thank you for the opportunity. Hope I'm audible.
Yes, sir. Please tell me.
Great. So my question is on this bulk procurement of fuel. We've already reached 41% of our consumption. Do we have levers to further improve this number to say about 50% or so?
Yeah, we already, consuming at an optimum level, but we are putting our own effort to see. Currently, we are operating with 7 own petrol pumps. Now, we may add another 1 or 2 going forward. But again, it all depends on the volume in that particular area. So there will not be, substantial improvement in these numbers, but at least 41% plus can be maintained.
Okay. And secondly, on external lorry hire charges, now that volumes being rationalized, if that is how I can put it, external lorry hire charges have also been optimized. With the increase in volumes, if at all they were to come in from H2, would these external lorry hire charges also bump up?
No, we are expecting there will not be much increase in the outside vehicles because some of the tonnage has been already now, decreased. But considering the capacity what we are having as of today, there will not be, major increase in the lorry hire charges, even though tonnage will increase from Q3 onwards.
Okay, we expect lorry hire charges to be at around this 4.5% mark on sales.
Yes.
Got it. Just one last question on volumes, sir, if I may. Any lead indicators that we may be on the lookout to expect volume growth coming in since H2? Would it continue to be better monsoons in southern region or any such lead indicators that you would want us to track to see if H2 volume if H2 sees volume growth?
See, one thing I would like to mention here that we will put all out effort to increase the business. Wherever opportunities are there, actually we wish to put an effort and grab such businesses. But ultimately it should be healthy business. That's what our motto as of today. And considering say good economic conditions you turn out, after the Q1 Q2 good monsoon, what you are mentioning, and some good industrial growth, definitely that will support and definitely we can accumulate those volumes going forward. But about exact growth in the volumes and how it will be turned out, more clarity we can give after the Q2.
Great. Thank you, sir. All the very best.
Thank you.
Thank you. We take the next question from the line of Sandesh Shetty from HSBC Securities. Please go ahead.
Hello, sir. Am I audible?
Yes, sir. Please tell.
Sir, you mentioned regarding CapEx that you will be looking at around 140 to 150 crores in vehicle procurement, and you're also looking at an investment in certain properties. So, sir, ballpark, what would be the CapEx, full year CapEx for what you're expecting for FY26? And will it be similar for FY27?
No, these property CapEx actually we cannot, define as of today. So basically, definitely we are having a surplus cash flow, and we wish to invest these surplus cash flows in good facilities, considering the long-term benefits. But again, defining the exact amount as of today is, as and when the transactions are crystallized, we can give those numbers. But for the time being, any surplus funds will be used for the reduction in the debt.
Okay. And sir, also, can you further explain what are the steps you're taking to expand your footprint in the north region? And because now that you have rationalized on the customers, can you further elaborate on that? What steps are you taking with respect to geographical expansion to drive volume growth?
We are expanding our branch network over there, and moreover, we are highly marketing on some of the commodities which geographically contributing. Like as we said, in the northeast sector, earlier we used to depend only the commodities which are consuming to the northeast. Now actually we are concentrating on the products like tea powder and tea products. Even we have analyzed those things, and we have identified the customers, and we have already finalized the rate structure with them. So we are expecting some growth from such product. Like that. Actually, wherever we go to the regional places, one is the product we analyze in that market, which are the potential products which we can add into our services. So based on that, actually we identify the customers and increase the tonnage.
Okay, sir. That's it from my side. Thank you, sir.
Thank you. Ladies and gentlemen, we take the last question from the line of Achal Lohade from Nuvama Institutional Equities. Please go ahead.
Yeah, thank you for the opportunity. Sir, if I understand what you're saying, essentially you're saying we want to sustain this margin. So margin is the core focus. Have I understood right? Like 18-20% margin?
Yeah, actually we want to concentrate on the healthy business. See, margin again, as I said, there are some employee cost is going to increase going forward, and there may be changes in certain cost structure, but realization will be maintained.
Sorry, I'm more asking from a thought process or strategy perspective. From next 1 to 3 year perspective. If I see earlier we did pick up this low margin business, pushed volumes, obviously had some impact on the margin, but we were growing the volumes. Now today we have decided that we will focus on the healthy volume, profitable profitability, so to say. And that I'm just curious to know, is that a number 18-20% range? Is that a ROCE you have in mind when you decide what pricing you should offer, whether to take that volume or not to take that volume?
No, now this first quarter definitely there will be good EBITDA margin. So the similar to like quarter 4, because there are no major change in the cost structure. From the quarter 2 onwards, there may be change in certain percentage in employee cost because it is due for increment. So based on these changes in the cost structure, our EBITDA margin will depend. But however, the realization per ton will be maintained.
Okay. Understood. And
Achal,
can you talk?
And more clarity will come on the margin again after quarter 2.
Sure.
Ladies and gentlemen, we take the next question from the line of Nishant Chauman from Geojit BNP Paribas. Please go ahead.
Hi, sir. Am I audible?
Yes, sir. Please.
Yeah. So my question is typically only on the staff cost. So if I notice, probably over last 4 years, our employee costs have been growing by something around 16% CAGR, while our revenues are growing by 12-13% CAGR. And also our employee sales as a percentage of revenues has been increasing to almost say 150 bp over last 4 years. So going ahead, I mean, if we are in a particular scenario where the volumes are not going to be strong enough, and if we continue to grow employee cost by say a similar rate, don't you think that would have an impact on negative? How much negative impact would that have on our margins?
Yeah, definitely that will have an impact on the margin, but ultimately we have to give increment to the employees also. The regular increase, whatever happened, these are all increased because of some internal promotions and some of the shift of employees to the newer geography. That's the reason. But as a regular process, actually we are considering the increase in the employee cost in the second quarter.
Okay. And sir, what would be the nature of these employee costs? Are they like more fixed cost, or are they like in some way correlated to the...
Cost is fixed in nature. Other than drivers, rest of all employee cost is in fixed in nature.
Okay, understood, sir. Thank you so much.
Thank you. Ladies and gentlemen, with that, we conclude the question and answer session. I now hand the conference over to the management for their closing comments.
Yeah, thank you each and everyone. Basically, there are a lot of questions on the volumes and profitability numbers. So considering these, the rationalization exercise what we did, we can give more clarity on these numbers once we complete either quarter 2 or quarter 1 or quarter 2. So with that, actually, we wish to conclude this call. Thank you.
Thank you. On behalf of Motilal Oswal Financial Services Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.